Yo, what's up, guys? Welcome to your bonus class. Sorry I had to do this separately. Um, a lot of stuff kept coming up this week, man. Super busy. Let me share my screen here. If you guys have any questions regarding this, please let me know in the mentorship chat, or you can just DM me, or you can use the bootcamp Discord to ask questions. Doesn't matter. Okay. Basically, it's just a couple, slides for passive income, which I personally also do it myself as well. And I know that Boots does it well. And this is actually what Max does in his large wheel account, right? Selling options for passive income. A couple things regarding that. Of course, downside protection for your shares slash long-term position, and also upside potential utilizing cash secured puts and potential profit from the shares position. Not only that, also being able to capture consistent passive profit on a weekly basis slash bi-weekly while being able to hang on to the shares for long term. A lot of us have shares, or maybe you don't, maybe you have a little bit, but most of us, it just in the beginning of this whole stock journey, right? We always start with buying a couple of shares of things we like, um, but we fail to realize that even though shares are forever, the downside risk still exists, right? So your account can still take a hit. And the reason why we incorporate these wheeling strategy is so that while the downside is happening, we're still able to capture profit and make money instead of just letting the shares just sit there, right? And just take a beating, right? Might as well win both ways. When the market goes up, you win on the shares. When market goes down, you make money on the covered calls. Okay. Now, if you are not interested in really making passive income, then it's I feel like it's still good to know anyways, right? So starting off with the first thing for passive income is selling calls to protect downside of the shares position, capture safe passive profits on a weekly basis, right? What do you need? Of course, the long-term shares. It depends on the average of the shares where you bought it at. Of course, the shares although has a potential for profit, it's still exposed to the downside risk, just like how we just discussed. We are going to be selling calls instead of buying calls to protect the shares to prevent the potential downside, right? So, for instance, uh, to sell one contract of calls, you do need to own 100 shares of an underlying stock. For example, if you own 100 shares of Tesla, you can sell any strike, just one call of Tesla for premium. Okay, and of course, if you own 1,000 shares, you can sell 10 calls, right? The sold calls can be in risk if the underlying goes above the strike price. Okay, so for example, right here, if you sold a $400 call, I mean, not $400, 400 calls on Tesla, and let's say Tesla is about to close a week above 401, you will get a sign, right? Assignment of shares will result in obligation to sell your shares at the strike price, okay? So if Tesla ends up closing at 401, you have no choice. The market will automatically sell you all your Tesla shares at $400 because that's the $400 call that you sold, right? So obviously, cover calls are in favor as long as the stock price stays below the call you sold it at, right? Now, does your shares get assigned immediately as soon as the stock price goes above the 400 in this example? No, it only gets assigned when the option expires, right? So the stock price could stay above 400 all week. But when it comes Friday, right? And Friday, like an hour before, brokers normally assign sometimes like hour or like 30 minutes before the market close. If the stock starts dropping back below 400 and it looks like we're staying around 395 or 398, then you're safe. You don't get assigned and you keep the full premium. Okay. Now, of course, if you wait till the absolute last minute, it is a risk because you might get automatically assigned, and brokerages are not really forgiving in terms of like unassigning it for you. Once they assign you, you're done. You can't really get it back. So a lot of times what people do is they take profit. So let's say uh you sold a 400C and it's, let's say, Thursday, and stock obviously keeps dropping, so you're gaining money on 400C. Think about selling calls is exact same as puts. The more it drops, the more profitable it is, but the profit is capped. You're capped at 100%. Okay. If you buy puts and the stock keeps dropping and dropping, you can keep making money, right? 200% gains, 200% gains, and so on. Cover calls are maxed at 100%. So if it's like, say, Wednesday or Thursday, Tesla dropped to like 380. So your 400 calls are like 85% to 90% gains. You can buy back the sold calls and keep the premium if you don't want to risk waiting until Friday. Because let's say uh on Thursday your cover calls was a 90% profit. Okay, and Friday comes, you waited just because you wanted 10 more percent to make it 100%. You waited till Friday and Tesla just starts going up and your cover calls are no longer in profit and it's gonna go past 400. Then you just, I'll go over what to do when the situation comes in a couple minutes, but that's like the reason why you like to always take profit. I personally like taking profit when it's 80 to 90%, you know. Let's move on to the next one. Okay. Now, we'll discuss this a little more later after the next slide, okay? I know it may be a little confusing for some, right? But we'll go over that in a second. Next is going to be selling puts. It's the complete opposite now, okay, with a possible upside reversal while being able to capture weekly premiums, okay? Just think about calls. If you sell puts, you make money when the stock goes up. It's the complete opposite, okay? Cash secured puts, however, there's a difference. Does not require you to own any shares. You don't have to own shares for you to sell puts. Because remember, to sell calls, you need to own shares, right? But cash secured puts, selling puts, instead, you're required to put a cash collateral. Okay. So in a way, generally, you do still need the amount of money for the shares. You just don't need the shares. Okay. So generally, to sell put, right? To sell one put, you need a cash collateral dollar amount of 100 of the shares. Meaning, if you want to sell 400 puts of Tesla, you need enough buying power / cash to be able to afford 100 times current Tesla price, which will be used as a collateral. You're not paying for it yet. It's just collateral. Okay. So obviously, let's say Tesla is at $300 right now. Okay. To sell one put, how much you need? 100 times current price, which is 300, which is 3,000. You're gonna need $3,000 as a collateral to sell one put. So you do need a quite amount of cash reserve to sell a lot of puts. Um, what happens during the purpose? Sorry, go back a little bit. Rewind back. The purpose of selling puts is to capture a little bit premium while also, sorry, being able to gain upside potential on your shares gains. Premium wise, you make the most money on selling calls, right? CSP, cash secured puts, is just a bonus. Okay. So how it works is instead of obligating to sell your shares like the covered calls when assigned, right? Remember, covered calls at the date of expiration, if the stock price goes above the strike you sold, you get assigned and you gotta sell it at the strike price, right? When you sell puts, it's the opposite. You're obligated to buy the shares, right? That's why they hold the collateral. Okay. You're obligated to buy the shares at the strike price instead of the underlying closes below. Okay. Remember the covered calls. If the stock price closes above the strike, you get a sign, right? This is the opposite. If Tesla closes at 399 and you sold a 400 puts, you'll be obligated to buy Tesla at $400, right? And they're gonna use that cash collateral you put in to purchase the shares. But you're not really, I think, if you think about it, not losing anything because you're buying shares. They give you shares instead of the cash. Okay. So now, obviously, this would be an issue. For instance, let's say your Tesla average. Okay. You bought Tesla, you got lucky with Tesla, you got Tesla like long time ago when it was $50 a share, right? You do not want to be buying Tesla at $400, right? You're paying $350 more than the average price, right? So you can kind of see where the issues may arise, but there's an option to extend the expiration date. Okay, in case, let's say, going back to the cover call slide, let's say Friday comes and you fucked up. Or you didn't fuck up, but Tesla just kept staying above 400C for the entire week, and it's Friday, and Tesla's at 405, it doesn't look like it's gonna slow down. So Tesla keeps going up, your cover calls keep showing minus, right? If you let it expire, okay, you're gonna be obligated to sell your shares at the strike price. Now, this could be in favor depending on what you want. Okay. Let's say again, your Tesla average is like really good, like the $50 a share, right? Being obligated to sell the shares at $400, you still make gains, right? But let's say you want to just keep the cover call trains going, right? And you don't want to get rid of the shares yet. Then you have an option to roll. Roll means you can extend the expiration date so that you're basically buying more time so that the Tesla comes back below 400 so that you can get 100% or 80 to 90 to 100% on the cover calls and you can keep full premium. Okay. Same thing with this. Let's say you sold a 400p. Okay. And Tesla keeps staying below 400 a whole week and Friday comes. You don't want to buy Tesla right now. You don't want to be obligated to buy it. Then you have an option to roll, extend the expiration to next week or the week after so that you have more time until Tesla starts rising so that it stays above 400. So that way you can keep your sold puts at a most gain. Okay, I know this may be really confusing for some. Please ask me. DM me if you have any questions, all right? So starting off with the calls, okay, you want to pick a strike price that is out of the money, right? Far from the current price, but you don't want to go all the way up, right? Because the more strikes you go up, the little premium you get, okay? So you kind of want to be in that perfect medium where you're not too far that you're making some premium, but you're not too close that you're in a risk of the stock going up. Again, when you sell calls, you don't want the stock to go up. You want it to drop. Okay? I hope it makes sense. So let's say right here, this example, share price 269. You don't want to sell call review. This is sell pretty explanatory, right? You see, you can't sell the Tesla calls yet because there's 0 Tesla shares. You need 100 shares to sell the call. Okay? Share price is at 270. You don't really want to sell 270 because it can break right away. If it goes above 270, then your cover call is already at risk, right? But 275, usually 2 to 3 strikes above. 1, 2, 3, or you can do 2. I would say 2, actually 3 to 4 strikes out of above share price is the safest, right? So let's say you had 100 shares of Tesla, okay? And you sold one contract of 275 call, right? Then you receive this in premium, $70, right? If you sell 10 of these, how much is that? That's a lot, right? That's $700 a week. Considering we're using weeklies, you're making $700 a week selling Tesla every week, as long as options expire for 80 to 100% plus. Meaning you would want the Tesla to stay above 275 for the entire week, or not entire week, at the date of the expiration or close to, right? As long as that happens, you can close out the covered calls and keep most of the premium. I say most because if you close it out 80%, you lose 20%. You see? Okay. Now, covered calls works in the same as puts or shorting the stock in simple words. When underlying decreases, the covered calls will be more profit, and cash secured put obviously works vice versa. You want to enter covered calls with the same aspect or criteria when looking for puts or shorting at resistance zones. Why? Because you simply want the stock to drop. Okay, you don't want to sell covered calls at support, right? Because at support, what happens? Stocks go up, right? That's where you do the cash secured puts. Where selling puts will give you profit when the stock goes up. Okay. Sorry. In this case, for Labu, you would be wanting to open cover calls, not here, because we're at a demand zone, right? You want to sell cover calls up here at a resistance, right? At 660, you'll be looking at a couple strikes out from Labu and selling those calls, right? So even if we like consolidate like this, as long as it stays above $6.50 or whatever strike you sold, you're going to be in profit, right? Same concept with cash secure puts. You do not want to be selling cash secure puts, okay, at the resistance. You want to be selling it down here at the support, right? So let's say you sold like a $5 put. You'll be safe for a while as long as it stays above, right? Now, of course, the further you get, the shittier premium you'll receive, but the safer it is. The closer the strike you sell to the strike price, the higher risk it is, but juicier premium. So you kind of got to pick your own battle. You rather take the safe route, make a little bit, but be more higher probability, or you want to take a risk and sell puts or sell strike close to the strike price with the risk of possibly getting a sign or having to roll. When you roll slash extend the expiration date, you don't make much premium. You sometimes make nothing, or sometimes you have to pay, right? So the best advice, safest advice, is really sell strikes reasonably out from the current stock price so that on a weekly basis you can take profit and make a weekly profit instead of having to roll. Okay. This is the roll option here, right? You just have to press roll, right? And select a new position. Okay. So let's say 63. Let's say you have current position 65. Okay. It says share price is 63, so that will be safe. But let's say share price is 66 and you don't want it to expire. You'll be rolling, select new position and roll it to 66. Or if you think that the stock price will fall back even next week, then you can roll lateral. Lateral means the same strike. So you can roll from 65 to 65, even though it's at 66 right now, if you think that it'll dip back below 65 anyways next week. Okay. These are what we just discovered. But I mean the lesson itself, that's pretty much it. I know I might have not done the best job explaining everything, right? I'm not the master of this, right? This is Max's specialty. But I've learned it enough to manage it myself. Uh, and it's given me a lot of opportunities to make money, so I am very thankful for this. There were some tough situations that I faced, but at the end of the day, I am profitable in terms of this. Really, it's hard to fail this because you win both ways, right? Unless you buy like some stock at like an absolute all-time high and the stock just keeps dying, then you're just gonna, be playing catch-up game with the premium, right? You keep making money on the premium, so your stock's gonna keep free falling. So the analogy that I love using when I tell my friends is, imagine just getting a mortgage, okay, and you're renting out the rooms, right? The mortgage, right, is the cash collateral slash the share position. Okay. And the rooms, you have tenants that pay rent. Those are the premiums you receive. Okay. So even though when your share takes a hit, when the market goes down, your house value is down, would you sell it for a loss? Absolutely not. You're just gonna keep renting the rooms out because there's always gonna be renters and keep collecting those rent money, right? So in the longer term, you make back the money that you lost from the market crash, regardless. It may take a year, 2 years, 3 years, but this is the long-term passive income wheel strategy, right? There's a lot of people that complain about, stock dipping within a year or two. Even my friends, honestly, this is no offense to them. They know I told them this before. You can't just expect to make money within a year or two. Like these people do wheels for like decades, man. You know, it's about looking like couple years out, learning the fact that in a couple years I'll have paid off my debt for my shares if I'm down, of course. If you're up, then that's great, right? If your shares are down, it sucks. I know, out of everyone, of course I know you have taken big hits before, right? But the fact that you're able to earn passive weekly income with pretty much a guarantee to make back the loss, it just takes a long time. I don't see, what's so bad about that, right? You being impatient with this, you're not a long-term trader. You only look at 1 year is not a long term. 2 years not a long term, right? There are long-term investors who's been investing for 10 years, right? I always tell my friends, like, dude, the one thing I wish I didn't do is invest like literally 5, 10 years ago, right? All these people that have made a lot of money through share position, they put, of course, there's ones that got lucky, right? But they're the ones that put money in like 5 plus years ago, right? So if you're looking to make the most value within a 6 months or a year, you're not in the right game for this. Don't do it because you're just gonna complain about it straight up. But if you're down for passive income weekly, right, and you don't mind some money sitting there for a while, this is for you, 100%. If you guys have any questions, please let me know. I know that might have been a little confusing, so please reach out. I'm still here for you guys.